VEQT or XEQT? It's one of the great debates on the internet, a commonly asked question. And does it really matter? In this video, I'm going to give you both a high-level and low-level breakdown of Vanguard's VEQT, one of the most popular all-in-one equity portfolio ETFs for you Canadians. If you want global equity exposure, no fuss, one ticker, this ETF may be your set it and forget it. But is it the best for long-term investing? What is the risk? I'm going to look under its hood. What's in it, how it behaves, what to love, and what to watch out for. Stay to the end of the video to see exactly how diversified VEQT really is. Let's do this! I'm Mr. Financial, and I help DIY investors like you understand ETFs and investing principles so you can invest with confidence, not based on the internet hype that we see. I'm going to start this VEQT deep dive with its performance. However, we need to do a high-level overview first. So what exactly is it? It is the Vanguard All-Equity ETF Portfolio, also known as an all-in-one asset allocation ETF. VEQT is like the Amazon of stocks. It contains pretty much everything. It has an asset allocation of 100% equities, meaning 100% exposure to stocks like all other EQT funds. And that's why this fund may grow fast, but also drop fast too, like the first drop of a roller coaster. You'll see later why this is a well-designed roller coaster. VEQT is a fund of funds and holds other Vanguard index funds that provide exposure to the broad-based equity markets. This gives it exposure to 13,670 stocks. Looking at the fun facts, you see the inception date was January 29th, 2019, a solid 7-year history. It has $12.3 billion in total assets. It has a 24-cent distribution per unit currently and does so annually. It trades in CAD on the TSX. It has an MER or management expense ratio of 0.24% with a 12-month distribution yield of 1.4% as of March 31st, 2026. All this information is found right on the main page of VEQT. It is really basic and requires no digging. But that's not enough to make a decision as to whether this ETF belongs in your portfolio. So let's now do what I love to do. Look under the hood and do a low-level deep dive, looking at the prospectus, ETF facts, financial statements, and Morningstar's KPIs for more insight. As I said, let's talk about performance first, because I know that's what you guys love. Am I right? Using the most recent monthly total return data from Vanguard, which is as of March 31st, 2026, since inception, it has a 13.11% average annual return by net asset value. Its 5-year return is 12.4%, 3-year return 18.6%, and even better, its 1-year return is 21.7%. However, its 1 month is negative 4.3%, as the market has turned nasty. Turning to the cumulative total returns, since inception, VEQT has returned 141.7% and 78.8% over the last 5 years. This highlights what long holding periods can do for total returns. Of course, in order to get these returns, you would have had to have invested at those exact same time intervals and had no additional purchases along the way. Looking at the annual total return by market price by year, it's varied from a low of negative 10.9% in 2022 to a high of 24.9% in 2024. This gives a little more context to its performance. Zooming in even closer, the quarter total return chart shows how varied the returns can be for a 100% equity portfolio. In Q1 of 2020, it lost 17.5%, one of 2 double-digit quarterly losses. And in Q2 of 2020, it gained 16.2%, one of 3 double-digit gains. Now let's really get granular and look at the monthly total return chart. This is important as it paints a more complete picture of how it has performed over time. The worst performing month was March 2020 during COVID, negative 12.7%. See all those red months? 28 of 86 months, or 33% of the time. The best performing month was April 2020 at 10%. There have been many 5 to 6% months. This performance doesn't mean much though until we benchmark it to something, and Vanguard uses a FTSE index. This is what it looks like compared to the FTSE Global All Cap Index, with its 10,189 constituents. In the management discussion of fund performance, they make a direct comparison to the index. Since inception, it's trailing by 0.85% in annual compound returns over the last 6 years. Remember though, VEQT has expenses that puts it at a disadvantage to a simple index. In the ETF facts, we get to see the best and worst 3-month performance, which gives us a little more understanding to how volatile an all-equity, all-in-one ETF can be. Its best was 16.2% ending June 30th, 2020. And the worst, negative 17.5%, ending March 31st, 2020. Again, that's what holding 100% equities looks like. Don't be fooled. This is not a conservative holding. Don't let the all-in-one label play tricks in your mind with you. Now, since we only have 7 years of data, I thought it would be cool to reconstruct VEQT using the underlying ETFs at the average weights like I did with XEQT. Of course, this isn't perfectly accurate as there is yearly or periodic rebalancing that would happen and a different fee structure, but it gives us an idea. Over 10 years, the 10-year CAGR on returns was 11.9%, so those extra years didn't see much of a drop-off. These rolling 3-year returns show how varied the performance can be depending on your timing, when you entered the position. And lastly, the 4 underlying ETFs had varying performance year to year. Some years, everything was positive. Others, 1 or 2 ETFs really carried the portfolio. And during 2018, the total US market was the only positive holding. Let's look back at the annual total return chart. Do you see the column income return NAV? That's what percent of the total return was from the distribution. I mentioned it has a distribution frequency of annually and currently yields 1.4%. This is what the annual distributions look like historically. There's really 6 relevant columns to look at. Eligible dividends are coming from the Canadian dividend-paying companies within the ETF. The foreign income is from the distribution/dividends from foreign companies. And right beside that, we see the foreign tax that the ETF had to pay. And lastly, there's the total distribution. It has increased from 40.375 cents to $1.27. That's nearly 150% growth in 6 years. Can we call this a dividend growth fund now? There are tax repercussions with the distributions outside of registered accounts. It can become a small drag on total returns in the accumulation phase of investing, so it's good to be aware of. So that's the solid performance of VEQT. Now let's shift gears and see where the performance was coming from by looking at the factor profile. This is what it looks like using Morningstar's data for VEQT over the last 5 years. You'll notice it's pretty neutral across the board. The exception would be to the momentum factor, sitting at the top of that range over the last 5 years. This makes sense since we are sitting at all-time highs after a strong bull run in many markets all around the world. It is also low on liquidity. The liquidity factor describes the trading frequency of a fund based on trailing 30-day share turnover. VEQT is close to in line with the category average. So I mentioned it is a fund of funds, and all these funds are passive indices, meaning management doesn't pick the stocks, rather they pick the ETFs, which holds a basket of stocks representing certain markets. The 4 underlying ETFs you see are all based on FTSE indices, with exception to the U.S. Total Market Index ETF, VUN. It follows the CRSP U.S. Total Market Index. It is these ETFs that give VEQT exposure to 13,070 stocks. Though, just to be clear, that number does include a lot of duplicates, like you see here when looking at the underlying holdings. More on this later, though. The FTSE Global All-Cap Index has 10,189 stocks for reference. The top 10 underlying holdings are quite similar to the S&P 500. They make up 16.9% of the fund, giving it a lot less concentration risk than many broad-based index ETFs. And VEQT includes 4 Canadian companies in its top 10: Royal Bank, Shopify, Toronto Dominion, and one energy stock, Enbridge. Are you wondering, why is this the case? Well, this brings us to the weights of the 4 underlying funds. This will dictate how diversified the ETF really is. VEQT behaves almost like a global market tracker with a lot of Canadian home country bias because that's what Vanguard has found to be optimal. Right now, it seems the fund uses what their paper says: 30% Canadian equities and 70% international. Many studies have been done on what is an appropriate level of bias and the pros and cons of it outside of what Vanguard literature says. VEQT doesn't have a target weighting for the 4 underlying ETFs. At least, it's not openly explained in their prospectus or other documents. The word on the street is the rebalancing is done to keep CAD at 30%, and the rest of the world market is cap weighted at 70%. If you know where these documents can be found that explain this, let me know where it can be found in the comments below. Like I mentioned, CAD home country bias is very high at 31.2% presently. Compared to the FTSE Global All-Cap Index, CAD is 3.2%. So that's about 10x that. U.S. exposure is currently at 53.7%, developed markets 17.9%, and emerging markets 7.2%. Of course, the world market indices do not all appreciate or depreciate equally. So this is where the rebalancing of an all-in-one fund is pretty awesome. According to the prospectus, its portfolio asset mix may be reconstituted and rebalanced from time to time at the discretion of the sub-advisor. Nothing set in stone. I don't think this is happening very often, though. The reason I say that is because rebalancing comes at a cost. So let's jump into that. VEQT has an updated management fee of 0.17%. When looking at the MER of the fund, at the latest report, it was 0.24%. So I anticipate this fund to drop by 5 basis points. Now that rebalancing cost should be seen in its TER or trading expense ratio. In 2025, it was 0%. So that's one reason why I don't think this is rebalancing that much. The other is the very small capital gain seen in the distributions. And lastly, the turnover rate of the fund is very low at 3% according to the Morningstar data I've seen. Quick thing, guys, before we continue. My goal is to always provide accurate information. So if you've been enjoying my content and have learned something new, please let YouTube know by liking this video and subscribing. Thank you so much for supporting the channel. Now back to the video. With this 70-30 split between Canadian and international markets, what is the geographical exposure of VEQT? Well, as of February 28th, 2026, its market allocation by country was 43.1% USA, 31.5% Canada, 4.4% Japan, 2.5% UK, and 2.1% China, and just down from there. Comparing that to the FTSE Global All-Cap Index, the US would be at 61.6%. We know Canada already. Japan at 5.8%, UK at 3.4%, and China at 3.2%. So the underweighting is substantial with all that home country bias. Let's see how this has impacted the sector exposure. As of right now, tech leads the fund at 21.8%, then financials at 20.1%. The smallest is real estate at 2.2%. This is quite different from a pure market cap index like the FTSE one we've been comparing it to. There, tech makes up 28.1% of the index, and then financials at 15.3%. Two notable differences. Now let's look at the fund style of VEQT with Morningstar's data. It is a large cap blended fund, with 35% of the fund as large cap blended, 22% large cap value, and 18% large cap growth. Compared to the S&P 500 or other more concentrated indices, VEQT has a decent amount of mid-cap exposure at 18% and small cap at 6%. Again, to be crystal clear, this ETF is not a growth fund. It is a blended fund. With the data from Morningstar, large cap stocks are those that together account for the top 70% of the capitalization of each style zone. Mid cap stocks represent the next 20%, and small caps represent the last 10%. This is what the MCAP looks like on VEQT's main page. Pretty similar, but still a large cap fund predominantly. Now, let's look at the price to earnings ratio to get an idea of the value of this fund. It is currently sitting at 20.6, which is on the higher side of things for the FTSE Global All-Cap Index. In comparison to the total US stock market, sitting at 25.4, a diversified fund like VEQT looks more reasonable. Now that we got all the exciting stuff out of the way, let's look into the boring risk profile. This is the part I personally think you'll want to especially pay attention to. After all, we need to know what risk we are taking on to get the return we discussed in the performance. So Vanguard has a risk rating of medium. And as we saw in its performance, it can have quite the yearly, quarterly, and monthly swings. Specific risks mentioned in the prospectus include country regional risk, currency risk, and investment style risk. Let's look at some risk metrics using Morningstar's portfolio risk score. Never take these metrics as the end-all be-all of risk KPIs. I say this every time. Morningstar rates this as an aggressive fund. It has a high return compared to its category with the same amount of risk. The beta is 0.96, which is a little misleading. I'll get back to that in a second. It has a great R-squared, meaning its beta is pretty strongly correlated to its benchmark. The fund is performing better than its beta predicts with a positive alpha score. Its Sharpe ratio is 0.84. The higher the better, showing a decent return for the risk taken. And its standard deviation is 11.33, much below the category average for 5 years. Now back to its beta. When it comes to beta, or how much the stock price can swing up or down compared to its index, in this case the FTSE Global All-Cap Index, we need the full picture. The downside capture was only 92%, with upside 98%. This is great to see. That beta of 0.96 is skewed to the downside, which is what you would want to see. Let's peek at the FTSE Global All-Cap risk metrics quickly. The risk-return ratio is pretty stable across the 5 and 10-year ranges. And the max drawdown was 34.3% in the 10-year time frame and 26.1% in the 5-year. Again, showing the swings that even a globally diversified all-equity portfolio will perform like. And the 5-year volatility using monthly data is 14.5%. I said to stay until the end of the video to see exactly how diversified VEQT really is. So here it is. The fund lists 13,760 stocks. After removing the duplicate funds, that number drops drastically. And did you know that there are nearly 2,500 stocks weighted at 0.0000%? So how do we measure concentration risk with a portfolio of over 10,000 stocks? That's where calculating the effective number of stocks can be quite handy, though not really necessary for a fund like this. It looks at the ratio of the portfolio's effective number of stocks to the total number of stocks. For VEQT, it is sitting at 190. Or another way to put it, it's like having 190 equally weighted stocks in the portfolio. Concentration risk is a debatable topic, and yet still worth knowing. So let's review this deep dive. VEQT is an all-in-one ETF with 100% exposure to stocks through 4 ETFs with 13,670 underlying stocks. Its market allocation is approximately 30% Canadian and 70% to the international markets. Fees matter, and this is where VEQT shines with its recent 5 bips reduction. You're paying 0.24%, likely dropping to 0.19% for a global multi-ETF portfolio. Who may this fund be good for? Someone who is looking for a simple, straightforward, and efficient long-term portfolio. Asset allocation ETFs in general give investors a way to build a whole portfolio in one simple ticker. VEQT gives you diversification across the entire world market, across all market caps, and is continually monitored and rebalanced as needed. Now, what I'm going to share next is important. I don't want this to be taken as fear-mongering. It's not. This is just the reality. VEQT is 100% stocks. A lot of stocks, but it's still all equities. That means it has higher volatility, larger drawdowns, longer periods to recover. Black swan events like war, inflation, currency swings, changing world powers, and so on greatly impacts stocks, VEQT included. This also has an overexposure to Canada, a very clear home country bias of 30%. When you compare this fund to the FTSE index, at a time the Canadian market is suffering, you may suffer emotionally thinking, why am I over Canada and under the international markets? All things to just be aware of. Now, here's my opinion on who VEQT is good for. Remember, this is just my opinion based on this deep dive. It's good for long-term investors, 10 years or more. It's good for passive investors who want to contribute regularly without worrying about timing. It's good for global diversification with no need to rebalance. It's good for investors comfortable with exposure to 100% equities. That means a lot of volatility. It's good for a core holding to build a portfolio off of and combine with other ETFs, or you can hold this as a standalone portfolio. And in my opinion, VEQT may not be for you if you are a conservative investor. That's something really important to know. If you're seeking to outperform the market, if you don't want NCAP indices, if you want tactical control of your portfolio's geographical weighting, sector weighting, if you like to have more control of the fees, and if you don't want 30% home country bias. So that's my full breakdown of VEQT, one of the easiest ways for Canadians to build a globally diversified, all-equity portfolio with just one ticker. The same could be said for XEQT, ZEQT, FEQT, and any EQT. I'll be reviewing many more ETFs moving forward, dividend ETFs, cover call ETFs, and so on. I've already made a ton. Check out this playlist right here. See you there.